Every time a missile lands in the Persian Gulf, someone in a Geneva office quietly makes a phone call. Not a panicked call, a calm one, almost bored, because they have done this before. They know exactly what happens next, which number moves first, which market cracks second, which currency quietly bleeds out over the following 3 months, while the rest of the world is still watching the satellite footage. This isn't a conspiracy. It's a pattern, one of the most reliable, repeatable patterns in modern financial history. 3 Gulf Wars, 3 oil shocks, 3 versions of the same chain reaction in almost identical sequence, like a song you've heard so many times you can hum the next note before it plays. The names change, the flags change. The financial mechanism underneath? Almost identical every time. And right now, with Iran, we may be watching the opening bars again. So let's talk about what actually happens. Not the politics, the money, the mechanism, the quiet math that sits beneath every Middle East headline, and why it eventually shows up in your grocery bill, your mortgage rate, and your retirement account, whether you're following the story or not. You have to start with oil. The Persian Gulf is not just a body of water, it is the circulatory system of the global economy. 20% of the world's oil supply passes through a single choke point, the Strait of Hormuz, at its narrowest point 21 miles wide. 21 miles between normal and chaos. Iran sits directly on one side of it. The moment any serious confrontation involves Iran, not a proxy skirmish, not a drone strike on a refinery, but Iran itself, that strait becomes a question mark. And the global economy does not tolerate question marks. Here's the first domino. Oil traders don't wait for the strait to actually close. They price in the possibility that it might. This is called a risk premium, the financial world's version of paying insurance on a house that might be on fire. You don't know yet, but the smoke looks wrong, so you pay. In 1990, when Saddam invaded Kuwait, oil prices doubled in 4 months. Not because supply collapsed, because traders were afraid it might. The fear moved faster than the tanks. In 2003, before the Iraq invasion started, oil was already climbing. By the time the statue fell in Baghdad, crude had gained nearly 40% from its pre-war price. Same story, different cast, same script. With Iran, the numbers get larger, not smaller. Iran is not Kuwait. It is the 3rd largest producer in OPEC. It has a navy, it has ballistic missiles, it has the ability to mine the Strait of Hormuz, which it has explicitly threatened multiple times. The risk premium on an Iran conflict doesn't look like 1990. It looks like something the models haven't been stress tested against. So oil goes up. That's the obvious part. Here's where most people stop thinking, and where the lasting damage begins. Oil is not just gasoline. It is the fertilizer in your food, the plastic in your phone, the fuel in every ship and truck that moved it to you. When oil spikes, it doesn't add one cost to your life. It adds dozens simultaneously with a delay of 3 to 6 months, which is exactly long enough for most people to forget what caused it. This is cost-push inflation, and it hits hardest at the bottom. Wealthier households spend a small fraction of their income on energy and food. Lower-income households can spend 40, sometimes 50% on exactly those things. An oil spike is a regressive tax, invisible, unlegislated, applied to everyone who can least afford it. After the 1973 oil embargo, U.S. inflation hit 12%. Unemployment doubled. The economy contracted. The conflict didn't even directly involve American troops. A crisis over there becomes a cost over here, every time. Now, here is the domino most people miss: central banks. When oil-driven inflation spikes, central banks face a trap. Their primary weapon, raising interest rates, was built for demand-driven inflation. Too much spending, make borrowing expensive, slow things down. That works. But oil shock inflation isn't caused by people spending too much. It's caused by a tanker captain who doesn't know if there's a war next week. You cannot fix that with interest rates. You cannot make oil cheaper by making mortgages more expensive. And yet, central banks raise rates anyway. Because if workers demand higher wages to cover higher fuel costs and businesses raise prices to offset those wages, inflation embeds itself into the system independent of oil. That is much harder to kill. So they act, even knowing the tool doesn't quite fit. Rates go up. The economy, already staggering from the oil shock, absorbs a second punch from its own central bank, deliberately, as a controlled burn to prevent something worse. In 1980, the Fed raised rates to 20% to kill inflation, tracing back to the 1970s oil crises. The U.S. went into recession. Unemployment hit nearly 11%. The cure was almost as bad as the disease. After the 2022 energy shock from Russia's invasion of Ukraine, the Fed raised rates from near zero to over 5% in 14 months, the fastest tightening cycle in 40 years. The housing market froze. Regional banks failed. The root cause, traced far enough back, was an energy disruption from a conflict most Americans couldn't locate on a map. There is an irony worth pausing on. The countries most financially exposed to Gulf conflict are frequently the ones least involved in it. Europe, Japan, South Korea, India all depend on Middle Eastern oil far more than the U.S. does. After the shale revolution, America became a net energy exporter, partially insulated from direct supply disruption. But oil is priced globally. A barrel doesn't come with a domestic use only sticker. When the global price rises, everyone pays it, including Americans buying gas from American refineries running on American oil. The market does not negotiate patriotically. The sharpest economic exposure sits in Tokyo and Frankfurt, and yet it's American carriers patrolling the strait. There is an entire geopolitical thesis in that asymmetry. We'll let it sit. Act 3 is currency, and this is where the damage goes global. When fear enters markets at scale, capital flees to safety. U.S. dollars, treasury bonds, gold. The dollar strengthens. For Americans, that sounds fine, but it hammers emerging market economies that borrowed in dollars. Here's the mechanism. A country takes on dollar-denominated debt because dollar loans historically carry lower rates. The debt sits on their books in dollars. Gulf crisis hits, dollar surges, and suddenly that debt, expressed in their own currency, has become significantly more expensive. Their economy hasn't changed, their productivity hasn't changed, but their debt load just got heavier because investors got nervous about a strait on the other side of the world. This is how a conflict near Hormuz contributes to a debt crisis in Turkey, or Argentina, or a dozen economies with no involvement, no proximity, and no say in what happens between the U.S. and Iran. Collateral damage in the most literal financial sense. Now, here is where Iran diverges from every previous Gulf conflict, and not in a reassuring direction. Iran has been under heavy sanctions for decades. Oil markets have partially priced in Iranian supply constraints. Banks have already pulled back. Some analysts argue the damage is baked in. A conflict wouldn't add much. That reading is probably wrong. What sanctions created is not an absence of Iranian oil, but an underground infrastructure for moving it. Iranian crude still flows through shadow fleets, through intermediaries taking reputational risk for the right discount, through Chinese and Indian refiners buying below market. Somewhere between 1 and 2 million barrels a day leave Iran through channels that don't appear on official ledgers. A direct military confrontation doesn't just stop that oil, it detonates the gray infrastructure around it. Intermediaries vanish. Chinese and Indian buyers recalculate overnight. Marine insurers raise premiums on every tanker in the northern Gulf, not just Iranian ones, because proximity to conflict is the risk regardless of flag. And then there is the retaliatory dimension, which didn't exist with Kuwait or Iraq. Saudi Arabia's Abqaiq facility, which processes 5 to 7% of global oil supply on its own, was struck in 2019 in an attack attributed to Iranian-backed actors. That was a demonstration. A direct conflict with Iran removes whatever restraint currently exists. The scenarios analysts model for an Iran conflict don't show a 20 or 30% oil spike. The severe scenarios, infrastructure strikes, extended conflict, Hormuz closure, go to numbers the modern global economy has genuinely never operated under. There is always, after these events, a narrative about how markets overreacted, how the worst predictions failed to materialize, how the calm money was vindicated. Sometimes true. Fear is a bad analyst, but the worst financial damage from Gulf conflicts rarely arrives at the peak of the crisis. It arrives in the aftermath, in sustained elevated rates, in debt accumulated during the high price period, in structural changes to shipping and energy infrastructure that take years to resolve. The second and third order effects don't make headlines, they just quietly alter the conditions everyone is living inside. The 1973 shock didn't single-handedly cause the stagflation of the late 70s. It set a chain in motion that ran for years. The 1991 Gulf War didn't cause the early 90s recession alone. It was one pressure applied to a system already carrying stress. Right now, that system includes elevated sovereign debt across major economies, a housing market that never fully normalized after 2022, a dollar facing more structural questioning than it has in decades, and a global trade system already fracturing along geopolitical lines that have nothing to do with the Gulf. The chain reaction doesn't need a perfect storm. It only needs one more thing to go wrong in an already loaded system. Nobody knows what happens next with Iran. Anyone who tells you otherwise is selling something. What we do know is the mechanism. Oil supply gets questioned, prices spike, inflation reaccelerates, central banks face a choice with no good options, rates tighten into a weakening economy, capital retreats to safety, devastating currencies of countries with no involvement. Debt stress rises, growth slows, not dramatically, not all at once, but persistently. And somewhere in a Geneva office, a phone rings. Someone picks it up, calm, almost bored, because they have run this calculation before. The real question, the one that never gets answered, isn't whether the chain reaction happens. It does, reliably, with a consistency that would be impressive if the human cost weren't attached. The question is, who decided the choke point stays a choke point? That 20% of the world's oil supply should keep funneling through 21 miles of contested water indefinitely, treated not as a problem to solve, but as a permanent risk to price in and manage? The answer is that solving it would require sustained, long-horizon coordination that markets don't reward and governments rarely survive long enough to complete. So we don't. We price in the risk and move on. We watch the satellite imagery, we track the tanker movements, we read the central bank minutes, and the next time a missile lands near the Strait of Hormuz, somewhere in Geneva, a phone will ring, and everyone will act surprised.